I've analyzed close to 1,000 retirement portfolios in my career and discovered a critical difference. Those that fail often share a few simple but impactful mistakes, while those that thrive look nothing like the portfolio suggested by Dave Ramsey, Susie Orman, or the conventional advice out there. The difference is the real line between stressing out for 30 years and cruising with confidence for 30 years. If you're new here, I'm Eric Rodriguez. I'm a certified financial planner, and I'm the founder of WealthBuilders, LLC. Having structured hundreds of retirement portfolios capable of withstanding the financial demands of post-work life, I'm prepared to share what I've learned. In today's video, I'll reveal why much of the standard portfolio advice is fundamentally flawed, and I'll disclose the specific strategies that have proven to be effective. Let's get into it. The usual advice for retirees, the safe, responsible, conservative playbook, is to move to a 40% stocks and 60% bonds mix in your 60s, or even more commonly, to make your bond percentage equal to your age. But here's the catch. This popular approach has a major fundamental problem that most people only figure out when it's too late to fix it. Many folks that followed this advice lost a lot in 2022 as bonds on average did negative 13%. If these folks stayed conservative, they likely still haven't recovered from that crash here in 2026. Others are locking their money away in annuities they can't touch without penalties, or they're dealing with inflation risk. Meanwhile, there's a quiet epidemic of portfolios stuffed with only U.S. large cap stocks, leaving retirees dangerously exposed. Now, being too conservative can erode your portfolio, but also having the wrong asset allocation can make the difference between running out of money or leaving a legacy. Combine both and you have a recipe for disaster. Take inflation, for example. According to Dimensional Fund Advisors, inflation can be a bigger risk than market volatility. Since 1975, inflation has averaged 3.66%. Compounded over 50 years, that means what costs $1 in 1975 costs about $6 today. This is why we invest. It's not just to grow wealth, but to preserve purchasing power. Along with inflation risks, many retirees concentrate in U.S. large cap stocks, which worked well in recent years, but can go through some very significant dry spells as well. For example, from the year 2000 to 2009, we call that the lost decade, the S&P 500 delivered just 0.95% annualized. Meanwhile, globally diversified portfolios saw international markets return 7% plus and emerging markets over 10% plus. So diversification isn't just theory, it's also protection against the wrong decade. And as my colleague Josh Brown has quoted many times, diversification is undefeated. So what typically lead to underperformance in many retirement portfolios? A few key patterns have stood out over my career. High fees from actively managed funds, overweight in U.S. large cap stocks, overconcentration in bonds, CDs, or annuities, no alignment between investment strategy and retirement goals. These patterns failed because they followed accumulation logic in a decumulation phase. In the growth years, volatility feels like a blip, but in retirement, that same volatility can ruin your entire withdrawal strategy. Diversification isn't enough if it's shallow. A portfolio of 500 similar companies in one country isn't truly diversified. True diversification requires exposure across asset classes, sectors, geographies, and risk premiums. If you are this type of retiree, or if you have a portfolio that isn't systematic, that isn't evidence-based, if you're working with traditional advice that I was just mentioning, the result is you might be living with chronic financial anxiety. You might be withdrawing less than what you thought you were going to be able to withdraw. You might delay retirement unnecessarily, or worse, potentially run out of money. And this is what I've seen throughout my career, is portfolios that weren't designed to deliver consistent income or withstand inflation and market risk. Despite all the noise, some portfolios worked. and they share a very common approach. They weren't chasing performance, they were engineered for outcomes. So what do they do differently? Well, let's take a look. Top performing portfolios leveraged a broadly diversified equity portfolio with a very moderate emphasis on size of companies, the value of companies, and the profitability of companies. So let me put this in context. If you took $1 invested in the S&P 500 in 1926, that dollar would have grown to $18,199 by the year 2024. But $1 invested in a portfolio tilted to small cap value and profitable companies would have grown to $166,000. This isn't theoretical, it's evidence-based. And it's why we implement an evidence-based approach at my firm, WealthBuilders LLC. These portfolios are diversified across the US, international, and emerging markets. They're tilted to capture the size, value, and profitability premiums of companies, structured to balance risk with goals, and they're capable of sustaining income while growing assets. What did these successful portfolios actually look like? How are they built? Well, they were diversified in the truest sense of the word. The most resilient retirement portfolios I've seen share common allocation features. They have a healthy blend of US large cap stocks, small cap, value stocks, and profitable companies. They have global exposure, so they have international developed markets, emerging markets, and real estate. And also, they have something called a diversifier sleeve, which is a hybrid between tail risk and high inflation and deflation ETFs that are designed to protect against both fast and slow market crashes. So here's what that looks like in action. In March 2020, the stock market dropped roughly 33% in just 24 trading days. That's what we call a classic fast crash. From 2022 to late 2023, the market gradually declined about 25% over 198 trading days. A slow crash that quietly eroded portfolios. Traditional bond-heavy portfolios struggle in both scenarios. Both these evidence-based portfolios stayed afloat by using diversifiers that kicked in precisely when needed. Finally, the portfolios manage sequence of return risk with a 5-year buffer of cash or short-term bonds, giving investors the flexibility to avoid selling during downturns. This approach works because it delivers both growth and stability, the peanut butter and chocolate, if you will, of investing. You have risk protection when markets fall and exposure to high-performing assets when market rise. Instead of white-knuckling every downturn, retirees stay invested with confidence, knowing that the plan accounts for both the known and unknown. So let's run through a hypothetical case study and run the numbers to see how this can work. So let's say Michael and Leslie both retire at age 65 with $2 million. They both withdraw 4% annually to cover their retirement expenses adjusted for inflation. And Michael is in a very conservative portfolio. He's in a 35% stock to 65% bond portfolio mix. He's going to get on average roughly 4% over his 25-year time in retirement. We're going to use a life expectancy of 90 for both of these hypothetical folks. Leslie's portfolio is a little bit more aggressive. It's 70% stocks, 30% bonds. It's in an evidence-based diversification model, and the average return is roughly about 8%. So again, by age 90, 25 years of retirement, when we run the simulations, Michael runs out of money around year 24 in retirement. His conservative structure couldn't keep up with inflation and withdrawals. Leslie, even after the same annual withdrawals, ends up with over $4.3 million left, thanks to a stronger compounding and built-in risk protection portfolio. So same starting point, same withdrawals, wildly different outcomes. That's the difference between hoping your portfolio works and building one that is actually designed to. If you're wondering whether your retirement portfolio is designed to last or just hoping it will, it may be time for a second opinion. Feel free to click the link below to book a free meeting with me. We'll walk through your current plan and see how it stacks up against what actually works. Because this isn't about guessing. It's about using real data, clear goals, and a very smart structure to build your retirement with confidence. Thanks so much for watching today, and I'll see you in the next video.